In this video, I'm going to introduce 3 Amazon programs in the financial industry that may change your view on this company. Similar to PayPal, Amazon Pay provides online credit and debit card payments processing service. So you don't have to create new accounts or enter card information. As long as you have an Amazon Pay account and has card and shipping information stored with them, the processor will take care of the rest of things. So shopping process with the PayPal or the Amazon app are faster and more secure than traditional credit card payment method. But these two companies, they do have some differences. Amazon is online only, but PayPal also has a mobile app for POS transaction, which is the point of sale transaction or face-to-face transfer. Also, Amazon Pay is not a wallet. It does not deal with ACH transaction, which means you cannot hold fund balance or transfer money from your bank to it. But PayPal can do it, while the company actually is not licensed as a bank, but as a money transmitter. So technically, Amazon would be able to do the same thing without the burden of being a full service bank. However, regulation is always dynamic. It could be that when Amazon decides to join a party and expose large volumes of consumer to liquidity and financial risk, regulation started to take it more seriously and require or a company in similar business to acquire a license. So Amazon has been taking a measured and gradual movement in this direction in the last decade. Visa and MasterCard play a different role in the payment process. They are a network, while Amazon and PayPal, they are the processors who facilitate the transmission of information back and forth from the network and their issuing bank. So they are essentially cooperating with each other in the supply chain. But there is actually one area where they may see each other as competitor. According to data from Statista, only 55% of adults in US have credit card. The rest of them is using either cash or debit card. So that means a lot of transactions do not go through the credit card network. And that's where Amazon can expand its footprint. For 45% of US adult population, that's a huge market. So actually, there is a service called Amazon Cash that is under the Amazon Pay system. It enables people to add cash to the card so that they can pay for online shopping or rewards or use it as a gift card. So of course, incumbents or fintechs who have been on the market for longer time, the Amazon do, have competitive advantage, and that is network effect. Since the cost from data center, for system building and maintenance are all fixed costs, so the larger transaction volume, the higher the profitability, and thus the more investment opportunity the company could have. So therefore, Amazon's priority now is to acquire people or merchants from outside of their ecosystem. So Amazon Cash is actually a good move. It's actually taking care of the people who is not shopping online because they only have cash. The other important deal is with a company called WorldPay. It's an acquirer bank that has annual payment volume of 1.6 trillion, even though it's only half that of MasterCard. But still, many of Amazon.com merchants can enable Amazon Pay on their own website to provide faster and more secure payment process for their customer. The next one is lending. Amazon took its first steps into commercial loans back in 2011 when the company began offering small business loans to merchants that are already in their marketplace. So that the Amazon loan is essentially working capital financing that allows merchants to scale up their business, their inventory during the holiday season to boost the revenue. The most important thing in reviewing lending business is actually risk management. So in the early days, credit risk and financing risk are all well controlled by the company. First of all, this is an invitation-only lending program. So decisions are made based on internal AI that trains on merchants' financial data. And financing risk for Amazon was also very low at the beginning because the company has strong operating cash flow and has acquired their secure revolving credit line to make the loan. But around 2017, 2016, as the big business getting bigger and bigger, credit risk, financing burden, and regulatory compliance are getting more and more difficult and costly. So the company realized that collaborating with established lenders who have strong balance sheet and capital source are the most efficient way to be in this business and at the same time to relieve their strong burden and stress. So later on, the company teamed up with BOA to make term loan to their existing merchants. And later, they also worked with American Express to offer revolving business credit line to the merchants that already have American Express card. This is a smart move because that really helped Amazon to reach merchants who are previously off the Amazon marketplace. And this is also a perfect chance for them to expand their ecosystem. And the most recent partnership is with Goldman Sachs. The deal is a little different because Goldman is the direct lender in this business, and they even have access to some merchants' financial data. Of course, that's with agreement and consent from the lender, from the seller. Both Goldman Sachs and Amazon will benefit from each other's customers and storehouse of data. This is a win-win deal between the new entrants and incumbents. Of course, where there is collaboration, there is competition. Amazon needs to be responsible to shareholders who wants to see larger market share and more profit. So even the lending was initially designed to help merchants grow business. It still needs to cover the cost and to create value for shareholder and other stakeholders. So Amazon needs to take competition seriously. PayPal and Square, the two competitors in the payment industry are also tapping into the lending world. So all three companies, Amazon, Square, and PayPal, they're pretty close in terms of their interest rate, their rate. But Amazon stand out with a much higher upper lending limit of 100K. So also, Amazon has a unique competitive advantage. The company generates 19% of their revenue from third-party selling service. So lending empowers merchants to expand the business, which in turn drives up Amazon's top line and thus creating more cash flow that is available for lending. And the best analogy to this virtuous cycle is alchemy. So they're creating more gold out of gold. So in insurance, Amazon's foray into the insurance sector started with the P&C industry. So instead of playing the role as non-writer, Amazon chooses to leverage on its size and customer base to be a distributor in 6 partnerships with both established insurance company and fintech company. So the earliest product is a white label insurance service called Amazon Products. Protect. It's issued by Warranty Group. Amazon uses its own brand name to give customer peace of mind when they're purchasing item, and itself does not have to take the risk of writing policy or the cost associated with settlement and others. So obviously, Warranty Group also benefit from the huge customer base that Amazon can provide. Another interesting deal is with travelers in the home insurance segment. So customers have nothing to lose when they can buy Amazon home devices at lower price and at the same time receive discount for their home insurance. There could be privacy concern, as many do, but the innovation in the product design has pointed to a new avenue for incumbents to generate revenue and create new value. So which could potentially compensate for the diminishing business in traditional market that have been taken away by many insurtech disruptor. And interestingly, Amazon itself could be classified as a disruptor. Because like many other insurtech, Amazon offer paperless application, speedy settlement, or even instant cash settling for low-value items, which makes it looks a lot like Lemonade. But unlike InsurTech, Amazon does not write policy. It's only a distributor. So if they want to scale up the business and preserve more profit from the business, they may need to acquire a license, which will bring a lot of regulatory cost that may not be able to be justified by the return that they can generate from the side business. So therefore, it's the management team's task to do the calculation and make the right move. And even in the health insurance regime, Amazon made a big move to form a joint venture with JP Morgan and Berkshire Hathaway to provide insurance for almost 1.2 million of employees within the 3 companies. For now, the new joint venture Haven is just a nonprofit organization that focuses on the benefit of employees. But Amazon is very clear about what they can offer and what they want in exchange. They have experience with IoT infrastructure, data analytics, artificial intelligence, and customer experience, which, according to Jeff Bezos, will be the driving force of an elevated healthcare system. So they are planning for the future market, and that requires dedication, long-term strategy, and aggressive investment, which what the 3 companies are all capable of. Now, we've reviewed Amazon's development in all 3 industry and compared its development with pure players in a specific market. Now, I want to talk a little bit about the comparison with other retailers, specifically Walmart and Costco. So they both company, they have their own financial development that serve the purpose of attracting customer and building an ecosystem. So they are going on a very similar road as Amazon does, but it's just that the scope and the efficiency of the outcome of their programs may not be as high as Amazon. So Amazon grows up with IoT and AI in its DNA, which is the engine of today's transactions, payment, and distribution system. Costco and Walmart, however, they lack the resource to develop their own network or system, and this would significantly impact the integration, efficiency, and profitability of their new application and investment. So they have the same goal, it's just that the outcome might be different.